Last month, I did a video on Realty Income. It got over 13,000 views. I learned a lot about the investor base of the company. A lot of people really like the company. They like the dividends. They like the monthly payouts and everything. They just love it. But other people, they actually don't like it at all. They think this company is a scam. They think that why should I buy Realty Income to get 5.5% dividend if I can get the same exact yield risk-free, putting it in my bank account or buying some kind of treasuries? And this is an amazing question. It's an amazing way to think about it, and I actually have an answer to this question in this video. Is gonna, I think it's gonna be helpful to a lot of you. I said that O has over 70% on the upside over the next 5 years in my last video. Now this upside potential has actually gone up a little bit because Realty Income is down around 4.5 to 5%. Since I made the video, I have a different way of actually valuing the company. So I'm gonna talk about the upside potential, the risks, and a lot of other things. And I think you guys are really going to enjoy this. Now, before I get into the video, I don't really want to waste a lot of your time on trying to tell you what the REITs are and what Realty Income is. Most of you, I believe, are familiar with that. And they have a pretty well-diversified client base in Dollar General, something like Walgreens, BJ's Wholesale Club, CVS, Walmart, and Sam's Club, something like 7-Eleven, Wynn Resorts, LA Fitness. So they have a pretty broad base in terms of diversification with the tenants, which would give it a much higher likelihood that the company is going to keep paying the dividends in case of an economic slowdown. And they are not really exposed to any kind of a major cyclical industries. They are exposed to theaters, like they have 1.3% in AMC and 1.1% in Regal. This is maybe the riskiest part of it, but it's nothing too crazy. Most of their diversification is within resilient industries, which is pretty great. The company has been paying a dividend for over 29 years. Pretty amazing. And they have been raising the dividend for 29 years, around 4.4% on average. And most people normally buy REITs like Realty Income because they want to get the dividend. But I believe for the first time ever, REITs are actually offering not only dividends, but also price appreciation, which is why I'm interested in REITs. This is why I own REITs in my portfolio. I own apartment REITs. I don't really own Realty Income, but I'm starting to get a little bit interested in the company as the stock has been coming down. But I do believe that this is one of the first times in a long time that you not only get a good dividend, but even price appreciation with these REITs. And I'm going to explain how in the end of the video. But this is the biggest problems that REITs are facing, and especially REITs like Realty Income. The company is pretty well leveraged, in my opinion. They have over $16.3 billion of long-term debt, and this debt is locked in at 3.6% interest rates, which is pretty amazing. But companies like O and other REITs, they always want to acquire new properties, and there's two ways for them to get funding to acquire new properties. They either have to take on debt or they have to dilute stock. This is the only two ways. And this is where Realty Income is stuck. Because if they want to take on more debt to actually do those acquisitions, they're going to have to pay maybe 5.5 to 6% interest rates. Their cap rates is likely going to be less than the interest rate, which is not going to really make a lot of sense. So they are not taking on a lot of debt. They're doing something else. And they're actually diluting shareholders by issuing stock, which would be the replacement for taking on debt. But the only problem is that Realty Income is issuing stock at record low prices, at record low valuations, which could potentially be destructive for long-term shareholders of Realty Income. If you look at the company is notorious in share dilution, but they actually did create value from it. I'm going to show you more graphs. But if you look at the shares outstanding of Realty Income since 2002, there were only 67 million shares outstanding. Now there's 612 million shares outstanding. Now, O was able to actually grow, if you look at the FFO per share, has actually been able to grow it over the past pretty much 20 or 22 years. So they actually did something well within the dilution, but it's hard for me, which is why I normally stick to apartment REITs, because most of them have flat shares outstanding. They tend to take on, locked in long-term interest rate kind of debt. They don't do a lot of that stuff. But this is the problem that Realty Income is facing. Realty Income is trading at record low valuation. If you look at the price to AFFO, adjusted funds from operations per share, which is a good way to look at it for REITs, the company is trading at record low valuations. I mean, as low as it traded in March 2020 and as low as it traded in 2010. So this is when normally companies would be buying back stock. You have a lot of REITs that actually do some of them buybacks, especially in the apartment REITs. But Realty Income is issuing stock at record low valuation because they have no choice. If they want to take on the debt, they're going to have higher interest rates. It's not going to make financial sense. So this is where Realty Income is stuck at. This is generally why it's underperforming a lot of the apartment REITs, a lot of other REITs, because if everything is still the same, but the shares outstanding are going up every single quarter, the price of Realty Income is going to have to come down, and this is just the way it is, and it could be potentially presenting an opportunity. I talked about the dividend. It's getting interesting. It's now around 5.5% paid out every single month. A lot of investors like the monthly payout, and they take it and reinvest the dividend. And as you can see from the historical graph, that Realty Income's yield is pretty much at record highs. And if you look at all of history, the highest it ever traded at was around 11% dividend. But this was in the 2009 financial crisis. I'm not sure if we're going there. But on a historical basis, Realty Income's 5.5% dividend yield is actually not bad. It's pretty much the same yield as treasuries, which why I would not be surprised if the stock goes down a little bit more and maybe Realty Income yields above 6%. If it ever gets to 6% yield or more, I would personally be extremely interested in holding it, maybe as a long-term investment. But this is how I think about Realty Income, that it's not only a dividend story, it's also a price appreciation story. And the price appreciation story is mostly going to come from a multiple expansion if we do have rate cuts in the future. Now, I'm not trying to predict this. I don't know when it's going to happen. Maybe it's going to happen next year, maybe 2 years from now, maybe 3 or 4 years, maybe 5 years from now. So we don't really know when, but it's generally been a good time to be buying REITs whenever interest rates are high, because whenever interest rates come down, they experience a multiple expansion, because if interest rates go back to 2%, which they eventually going to have to go back to 2%, O's 5.5% dividend yield is going to look very, very attractive, which is going to give it a multiple expansion, is going to give it more share appreciation, which is why I believe that it's maybe one of the few times where you could actually get the dividend yield and some potential share price appreciation. And this is how I think about Realty Income. The FFO per share has been growing around 4.5% over the last pretty much 6 or 7 years. Sometimes it grew 6%, sometimes it grew 9%, but on average around 4 to 4.5% has been the average growth rate of the FFO per share. This is after dilution of Realty Income. So the way I think about it, I put in around 4.5% growth from the 2023 FFO per share from 2023 to 2027 using the 4.5% annual growth for the next 5 years. I got $4.89 of FFO per share for Realty Income. If I take the $4.89 and we look at the historical average of the multiple for FFO per share, it's been around something like 17.5. Now it's around 13.7. So all we're assuming is that Realty Income eventually goes back to the historical average. All we're assuming that eventually interest rates are going to be lower 5 years from now, not higher, which is a much better bet to make. So if we take this number and we take the $4.89 and we time it by 17.5 for the multiple for FFO per share, we get around $85.57 per share. Now we take the $85, we divide it by the current price of around $56. This is around 52% on the upside, not including the 5.5% dividend. With a dividend that's 5.5% every single year for the next 5 years, this is around 28%. We add 28% to 52%. This is pretty close to 80% on the upside. But I personally believe that you could get maybe around 52% on the upside, not including the dividend over the next 5 years with something like Realty Income, which would be around 10% every single year. Because if it grows the FFO per share around 4.5% and you have a 5.5% dividend, if you get no multiple expansions, the worst case scenario, you should get around 10% every single year. This is not financial advice, but for my personal opinion, 10% a year on a cash position, if I put some cash in Realty Income, that's an amazing return, not including a potential price appreciation if the Fed potentially cut rates 5 years from now, which is a very high likelihood kind of scenario. So this is why I'm starting to like the company. It's starting to offer some price appreciation and also some dividend payments. Now I'm not saying the stock has bottomed. A lot of you commented on my last video because the stock went down 4%. I got comments, people said this video did not age well. It's only 4 weeks old and the stock is only down 4%. So if you want to buy something that no one wants to buy, like REITs, you have to be open-minded to dollar cost average on the way down, and you have to question your thesis, make sure your thesis is aligned, and dollar cost average on the way down, because we don't know how far Powell can take interest rates, maybe 6 or 6.5%. In this case, Realty Income is going much, much lower, and you have to be open-minded to maybe be wrong for a while, to dollar cost average down until the tide shifts, and then you could actually realize the value in your investment. Again, not financial advice, of course. This was just my opinion. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.